Hello, wherever you are. I'm Chris Mercer. I call myself a businessman and a valuation guy. I've been working with closely held and family business owners for more than 30 years, helping resolve and solve their valuation related issues, and in more recent years, ownership transition issues. I blog at chrismercer.net, where I talk about business value and ownership transition. I've written a couple of books recently. One's called Unlocking Private Company Wealth, where we talk about tools and techniques and perspectives on managing the wealth in private companies and then unlocking that wealth sometimes prior to sale so that owners can diversify their portfolios. The other book is closely held, buy-sell agreements for closely held and family business owners, because every successful closely held business with 2 or more shareholders should have a buy-sell agreement. I could argue that even with 1 shareholder you should have a buy-sell agreement, but call me if you think you have an interest in that. And then there's a Kindle book, Buy-Sell Agreements for Baby Boomer Business Owners. Today, I'd like to talk for a few minutes about some basics of business valuation. Business valuation, in a sense, is simple and is summarized by a basic valuation equation that I call this. Value is equal to earnings times a multiple. The earnings are appropriate earnings for the multiple, and value is derived. So valuation really is quite simple. All you got to do is figure out what the earnings are and then figure out what the multiple is. Well, if it were that easy, companies like Mercer Capital wouldn't exist, and I wouldn't have had the pleasure of doing the kind of work that I've done for the last 35 years. This equation really comes from another basic valuation equation. It's called the Gordon dividend discount model, or sometimes simply the Gordon model. It says that value today, V0, is equal to cash flow 1, or expected cash flow in the next period, capitalized by a discount rate R minus a growth rate G. So this is expected earnings capitalized by a discount rate less a G. We can expand that and look at cash flow over 1 over R minus G, and we have exactly the same algebraic value. So now we go one step further and say that cash flow 1 times a PE, because you see the PE is precisely 1 over R minus G. The PE, the multiple, is a function of risk and expected growth. So cash flow 1 times a PE is equal to earnings times a multiple. We've now introduced what I call the valuation triumvirate. The valuation triumvirate says that value is a function of expected cash flow, of the risk of achieving those expected cash flows, and of the expected growth of those cash flows. When we look at cash flow, we might look at the level of earnings, we might look at the margin of earnings, we might look at the quality of earnings, and any other aspect of earnings that makes sense. But we want to understand earnings. We also want to understand risk. That's the discount rate. Risk is inversely proportional to value. If I increase risk, because you see risk is in the denominator, then I'm going to decrease value. Conversely, if I decrease risk, I'm going to increase value. It's a very simple concept, but it's one that people, business owners in particular, and advisors need to really think about, particularly when you're working on your business day by day. And then finally, growth. It's fairly clear that $1 today is worth more than $1 tomorrow. So if I have more dollars tomorrow, it's worth more than less dollars tomorrow, because I have more dollars in the future that at a faster growth rate. So growth and growth is inversely proportional to value as well, because growth is in the denominator with a negative sign. If I increase growth, I decrease the denominator. If I decrease the denominator, I increase value. So we can look at risk, and we can look at growth, and we can look at expected cash flow. It's really, conceptually, not that different. So when we say value is equal to earnings times a multiple, we really are looking at the economics of cash flow being capitalized at a risk-adjusted level. And we may be obscuring that and looking through all of that. In another session, I'll talk about this particular equation and the assumptions that are important for it to hold true and how it relates to the discounted cash flow, a model for valuation. But value is equal to earnings times a multiple. All you have to do is figure out what the earnings are and then figure out what the multiple is. Multiply those two and you get value. But as I said a few minutes ago, if it were that easy, then people like me wouldn't be in business or wouldn't have been in business for 35 years. That's today's lesson. I'm Chris Mercer. I blog at chrismercer.net, where I write about business value and ownership transition. I look forward to seeing you in the future, and until then, be well.